What's going on, guys, and welcome back to another video. So today we're going to be talking about Paysafe, and I think that there's a really interesting opportunity here following the recent sell-off. So Paysafe is a company that was recently listed and it came to the market via a SPAC. Now, I've always said to be very wary of SPACs, and particularly around this area here where we see a massive uptick in pretty much every SPAC that was listed. And you can see here that Paysafe rose to $19. And this is actually where the company caught my attention, naturally, just because I thought that it had seen a very sharp rise in its price. So I took a little look into it. And I didn't like the valuation at that time, and so I never really looked at it again. So fast forward 7 or 8 months, and we are down 55% on the stock. And so now I'm thinking, okay, so let me take another look. Let's reevaluate. Is it now time to get in? So we're actually at $8.72 currently, which is lower than the initial SPAC price. So is there an opportunity here? Can we see some value? And the short answer is yes. I think that there is. I think that there's money to be made on this stock, and I'll explain why in this video. So in terms of what Paysafe actually do, we can see here from their F1 filing, we offer a broad selection of business-to-business and business-to-consumer digital commerce solutions to online businesses, small, mid-sized business merchants and consumers through our proprietary Paysafe network. So they actually operate through 3 separate segments, right? So they have their digital wallet segment, and this is digital wallet solutions enable users to upload, store, withdraw and pay funds and alternative payment models from a virtual account. So think Skrill, Nutella, I'm sure we've all heard of those. And Paysafe isn't a small company, right? So they actually are the number 2 in terms of their market position, global stored value digital wallet. And actually this is a space that is growing massively. And we'll come on to that in a moment. In fact, let's just flick over to it now, right? So we can see here that use of closed mobile wallets will increase in North America. So mobile wallet market size in North America is reported to exceed a staggering $80 billion by 2026. The closed mobile wallet segment is projected to show robust growth trends in the coming years in the region and will grow at a compounded annual growth rate of 20% between 2020 and 2026. So that's very positive, right? And considering that Paysafe are the number 2 in this space, that is very good as well. So they are primed to take advantage of that growth. And in terms of the amount of revenue that that's pulling in for them currently, so their 2020 revenue for that was $400 million. So digital wallets are commonly used in the online gambling industry, and we all know how much that is growing, particularly in the US with the recent legislation. And we can flick over to their customers here, right? So we can see that they've got DraftKings, Bet365, William Hill, Bitpanda, so all very large companies, all very well established. And as they continue to grow within the US particularly, we're going to see that growth within Paysafe as well. Their second segment is the eCash solutions, and this is the proprietary digital currency solutions empowering online, mobile and in-app commerce for gamers and cash users. And they have the number 1 market position in this industry. So that is generated $333 million of revenue in 2020. But this is another industry that is growing very fast. So in terms of their customers, we're talking Fortnite, Twitch and Spotify. And then in terms of their largest segment currently, but I don't think for long, because I do think that digital wallet and eCash solutions will eventually take over, we've got integrated processing. This is the online integrated and point of sale solutions for small, mid-sized businesses and online sellers to accept payments across channels. They are the number 4 independent merchant acquirer in the United States, and they are processing transactions of $68 billion per year, and that's generating them $720 million in revenue. And one of the interesting things here, right, is the opportunity for margin expansion. So currently integrated processing makes up around half of their revenue, right? So we've got $720 million in revenue, and they earn a gross margin of 57%. Now, if we look over to their digital wallets, that earns gross margins of 75%, which is obviously much better. However, the digital wallet space is growing at a faster rate and is projected to grow at a faster rate than their integrated processing sector. Therefore, over time, we're expecting our gross margins to actually increase, which is obviously very good for the shareholders as the business becomes more and more profitable. Now, the chairman of Paysafe is a man named Bill Foley. And for anybody that doesn't know, he has a very strong track record of increasing shareholder wealth, particularly through mergers and acquisitions. And he's employing the same tactics with Paysafe. And if you just Google Paysafe acquisition, it seems like every other day they're acquiring a new business. And we're not going to go into all of those today. In fact, we're not really going to touch on any of those because a lot of them are quite small acquisitions which should return shareholder value far out into the future. So for now, we're not going to consider them. But the point is this, right? Look at the man's track record of increasing shareholder wealth. So you can see the companies along the top here and the date of the initial investment. And at the bottom here, we have the multiple of equity. So what was the return? So we see 20x, 30x, 14x, 7x, 5x, right? And that 5x was in, a couple of years. This man is somebody that knows how to increase shareholder wealth, and he executes very well on that. So having him at the top of the company or as the chairman is very, very good for shareholders, and it's not something that should be discounted. And if we just flick to the most recent quarterly results, we can see that they reported 13% year-over-year revenue growth, and that figure actually rises to 16% year-over-year when we exclude the pay later, which was divested in October 2020. It actually says here, or reads here, pay later. It should read pay later. Anyway, it doesn't really matter. The point is that they sold their pay later business to try and move away from the sort of buy now, pay later, which is deemed as a little bit more risky than the more traditional payment processing. And then in terms of Paysafe's acquisitive business model that I was mentioning earlier on, we can see here that they made 2 key acquisitions in the quarter, and these are expected to add $60 million in Paysafe revenue and $20 million of adjusted EBITDA in 2022. So they're not large acquisitions, but nonetheless, they're very positive. It shows that they are looking to grow. So it can be taken as a positive as long as they're paying a fair price for these businesses and they are helping Paysafe to grow. And then just coming on to their full year 2021 guidance. Now, this is going to be quite important because we're going to be using this in our price target for the company, right? But they're expecting revenue of around $1.55 billion. Now that's between 9 and 10% revenue growth, which seems quite low, but you have to understand that that includes the fact that they have divested some parts of their business. And it doesn't really include the investments that they've made because we're not expecting the revenues to come in from those straight away. Therefore, sort of going forward, we're actually expecting the revenue growth to be slightly higher. Now that is also in line with what analysts are expecting. And the general consensus is that analysts are expecting around 13% revenue growth year over year for the next sort of 5 years for this company. But we'll get onto that later on. And then we're expecting gross margins of between 61 and 63%, which is very good. And an adjusted EBITDA margin of around 32%, which is also very strong as well. So we can see here on Simply Wall Street that Paysafe's revenue is forecast to grow at around 12% per year. And we're actually going to be using a figure slightly lower than that within my price target, but it just gives you an example that actually the company is forecasted to grow quite nicely. And actually, when you look at their forecasted earnings growth, we can see that we're just on the cusp of profitability. And actually, once we do hit that, we're expecting quite a sharp rise in their earnings growth. So we've got here $200 million in earnings or net income per year by 2023. Now, very quickly, in terms of their balance sheet, although they are carrying quite a bit of debt, when you actually get into the detail, you realize that their balance sheet isn't too bad. Anyway, so they have here $275 million in cash, and then they've got customer accounts and other restricted cash of $1.3 billion. Now, you have to be careful here. This is customer accounts and other restricted cash. This isn't actually cash which Paysafe has the right to. Okay, so if we actually go down to current liabilities, we should see, so funds payable and amounts due to customers, just under $1.5 billion. These two more or less net off, right? So effectively, customers are holding their own cash, and Paysafe had to report those on their balance sheet. And then because they're holding someone else's cash, they obviously have to report a liability as well. So something like that is just something that you do have to look out for when you are looking at a company's balance sheet. Either way though, for the sake of simplicity and because they do pretty much net off with each other, we can just leave them in for now. So they've got total current assets of around $2 billion. And if we go to total current liabilities, they've got just under $1.8 billion. So they've got a current ratio of just above 1, which is very good. So there's no sort of short-term liquidity issues there. If we go across to long-term assets or non-current assets, we can see that they don't really have too much going on. They've got intangible assets of $1.5 billion, and then they've got $3.5 billion of goodwill. Now, remove the goodwill because it's not something that you can sell, and really it's just inflating the balance sheet, right? So they've got around $1.5 billion, thereabouts, of total current or non-current assets. If we look at total non-current liabilities, they've got $2.5 billion, right? So that's not very good on the face of it. They've got $2 billion of non-current debt. However, right, is that debt serviceable? So in other words, is the company generating enough free cash flow that they can pay down that debt? They can pay the interest payments and they can also pay down the debt so that they can deleverage the company. So if we go down to the cash flow statement and let's take a look whether Paysafe can service their debt. So I know that Paysafe are expecting to make around $360 million in free cash flow for the current year, okay? If we go down to their interest expense, which we should see, okay, here. So they have incurred or had to pay $20 million in interest for 3 months. So multiply that by 4 for the full year. you've got around $80 million in interest payments. Now they're generating around $360 million in free cash flow, and therefore that they can cover their interest payments around 4 times over. So that's pretty good, right? Or 4.5 times over even. So there's no sort of concern that they can't pay down their interest, and clearly that leaves more than enough cash left over to grow the business and also pay down the debt. So is their debt serviceable? Yes, it is. It's not really a concern at this point because they are very free cash flow positive. Okay, so that brings us on to my very rudimentary 2025 price target for the company. So we can see here that their current share price is $8.72, shares outstanding of around 723 million. That gives them a current market capitalization of around 6.3 billion. When we take away the cash, add on the debt, we get a total enterprise value of around $8.2 billion. Now, this is effectively the actual price that you're paying for the company, because as you're buying the company, you are taking on the debt as well. Now, when you are analysing a company that does have a lot of debt, it is always important to make sure that you do consider enterprise value. So it's not very useful to use, for example, a PE ratio for a company that is very highly leveraged, because you're not taking into consideration the fact that it has a load of debt, right? So that's just one thing to bear in mind. Enterprise value is always a better metric to use rather than just price per share or market capitalization. Now, in terms of my assumptions for my price target, I've gone with revenue growth of just 10%. Now, that is quite conservative, right? So we've already seen on Simply Wall Street that the analyst consensus for revenue growth is around 12% per year. I've gone with 10% just to remain a little bit more prudent, and this is a sort of 5-year or almost 5-year price target. And actually for 2021 figures, I've just used management's guidance. So $1.54 billion in revenue, we saw that earlier on. And then gross margins of 62%, again, management have said that. And then adjusted EBITDA margins of 32%. And then free cash flow conversion for the current year of 67%. And that actually rises to 70% thereafter, which is in line with historical results as well as sort of what we're expecting for the business going forward and what management are expecting. Now, that free cash flow conversion is actually slightly lower than what I think that they can achieve. But again, just to try and remain prudent, I've gone with 70%. Now, bear in mind that actually 70% free cash flow conversion is actually very good. And I think that that's actually a larger percentage than what PayPal achieves. And PayPal is very much a free cash flow beast. So 70% free cash flow conversion is very good. Now, if you are unaware, right, free cash flow conversion is effectively how much of that EBITDA actually flows through as free cash flow. So effectively you get your free cash flow and divide that by your EBITDA or adjusted EBITDA and get a percentage from there. Anyway, my valuation model has gross margins of 62%, which is largely in line with historical results as well as what management are expecting going forward. EBITDA margin of 30%, which is actually slightly lower than what we know that they can achieve. So in the current year, they've achieved 32%, or they're going to achieve 32% in 2021. And I've actually reduced that down to 30% going forward, just to remain prudent. And as we just mentioned earlier, free cash flow conversion of 70%. So that means that by 2025, we're expecting them to be achieving revenues of $2.3 billion, adjusted EBITDA of $676 million, and free cash flow of $473 million. I just want to stress that these figures are really quite conservative. I actually think that they will, far surpass the figures that I've put in here, but I like to remain prudent so that I get a greater margin of safety, right? So these are the figures that we are forecasting. Personally, I think that they'll probably overachieve. Anyway, we'll see what they come out with on the valuation. So now we have those figures, we need to apply what we think is going to be a reasonable multiple to each of those metrics in 5 years' time. Now, this is arguably the most difficult part of the valuation, right? But what we can do is we can look across to some of their peers and some of their competitors to see what kind of multiples they are attracting and then consider whether that would be fair to apply to Paysafe. So what I've done is I've gone and taken a look at different payment processes within this sort of industry, sort of similar industries, and see what kind of multiples they are attracting, right? So I guess one of the obvious ones is because it's so large, PayPal. Let's see what kind of multiples PayPal are attracting. So in terms of the enterprise value to EBITDA, they have a multiple of 63 times, which is absolutely huge, right? They have an enterprise value to revenue of 13 times, and they have an enterprise value to unlevered free cash flow of 68 times, which is absolutely massive. If we actually look at the sort of more historical basis, because we know that PayPal has seen a massive run up, and so at the moment it is quite expensive compared to where it has been previously. Even if we look at some of their more historical results, we can see that it always hovers at around, somewhere between sort of 50 and 70, right? It was as high as 77 back in February 2021. And actually, even if we look on a sort of 3-year basis, we're looking at values between, the lowest it got to was 26, the highest it's been is around 75. Somewhere around 35, 45 is probably around fair. So PayPal, it commands a high multiple because it is such a good quality business. I'm not saying that Paysafe should have the same multiple as PayPal, but this is just for reference, right? We can discount based on the fact that Paysafe isn't as large of a business. It also isn't growing as quickly as PayPal, and therefore it's going to command a lower multiple. But we'll take that into account in our valuation. And effectively, I've done the same thing for a number of different competitors or similar companies within similar sort of industries. You can't get them exactly the same, but this similar type of industry, right? So if we look at Square, we know that Square is rather expensive, right? Enterprise value to EBITDA of 288 times. Okay, if we look across to global payments, I think that is very much lower. So 18 times for global payments. I think I looked at Afterpay as well, 951 times enterprise value to EBITDA. Anyway, you get the point. We won't go through all of them here. What I have done is I've summarized them right here, and we can see that enterprise value to EBITDA, the average across these 4 companies is 107. The average for enterprise value to free cash flow is 157, and the average for enterprise value to sales is 22. The thing is though, right, is that a lot of these companies are very fast growing, so PayPal and Square in particular, Square in particular, right? And therefore they command very much or very high sort of multiples. And therefore I don't want to apply those to Paysafe. However, is it reasonable for us to say, okay, an enterprise value to EBITDA multiple of, let's say, 25, right? I think that 25 as an enterprise value to EBITDA multiple seems fair when we consider that the average for this sort of space is 107. Similarly, for enterprise value to free cash flow, if we apply 25, and for enterprise value to sales, it's 22. The lowest is 7. Let's go even lower than that, and let's apply 7, right? When we do that, we get a price target, 2025 price target, according to the enterprise value to EBITDA of $23, $16 according to the free cash flow valuation, and $22 according to the enterprise value to sales. It gives us an average price target in 2025 of $20. Now, if you just started investing in, say, March 2020, and you've timed it very well, and you've achieved some very good returns, you might think that the price going up from $8.72 to $20 in effectively 4.5 years is not very good, right? But that's a compounded annual growth rate of 21%. Now, that is very, very good. So the S&P sort of historical average is around 9%, right, per year. If you can achieve 21% on a compounded basis, right, for the rest of your life, you will retire very, very wealthy. So 21% compounded annual growth rate potentially for this business over the next 5 years is very, very good. And actually, these are very conservative figures. I think that it will probably outperform those. And you can see how much this valuation can change if you think that Paysafe should be commanding a higher multiple. So we've seen here that I've used well below the sort of industry averages in terms of the multiples that I've used. If we use something like 30, and say 9, we can see, not 3, we want 30. We can see that that compounded annual growth rate increases to just shy of 27%, which again would be very, very good. I would prefer to err on the side of caution, and therefore I go 25, 25, and 7. Look, I think an average price target in 2025 of $20 is conservative, but even still, 21% compounded annual growth rate, I'll take that all day long. Anyway, guys, I hope you have enjoyed the video. That is all I've got to say for now. Comment down below on what you think about Paysafe and whether this is an investment that you are looking at. In terms of the disclosure, I don't currently have a position, but I am pretty much certain that I'm going to be opening a position very, very shortly. So I'm doing a couple of things with my portfolio at the moment, and I think one of the sort of companies that I'm going to introduce is Paysafe. Comment down below what you think, and thanks for watching.